What's up, everyone? It's Scotty with MoneyVest. So today we are going to be talking about a brand new semiconductor company. This is a company that we have talked about in the past, but I think it's important to continue to update our analysis on this stock because semiconductors are going to be huge in the future. And this is a company that also focuses on Internet of Things, so IoT, analog devices, and basically kind of focusing on industrial and mobile communication services and networks and basically designing chips for those parts of the industries, right? So automotive, IoT, industrial, all those things. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. You do get a lot of access to our members only private videos. So there's going to be over 40 videos that you can unlock by joining our Discord and Patreon. All these are going to be over here, as you can see, and you can also access and unlock all these spreadsheets that you can, again, view. That's going to include the intrinsic value spreadsheet as well, where you've got a list of all stocks and my fair values, and of course, unlock 20 plus Discord channels with, again, trade alerts and trade ideas. Everything's going to be included in Discord as well. So Patreon link's going to be down below, 16% annual discount that's available till the end of this month. So the company that we are talking about today is going to be NXP. So NXP Semiconductors. It is a Dutch company based out of the Netherlands, and they also, again, provide secure connectivity solutions for embedded applications. NXP is a pushing boundaries in the automotive, industrial, and IoT, mobile, and communication infrastructure markets, and again, they kind of compete very well with Qualcomm, other chip designers, including the likes of NVIDIA, AMD, but they are more towards the GPU and CPU side. But NXP are focusing more towards the automotive, industrial, IoT, and mobile applications, and they're chip designers as well, right? So they are basically designing chips. They're not the ones, well, maybe there's a little bit of manufacturing in place because, again, they are a designer and a manufacturer of semiconductors. Now, if you take a look at our quantitative analysis on this company, so this is our 70 metric, MoneyVest metric that we've put together, and then things that we look at every single company, right? So this is going to be the financial health, this is going to be the growth and profitability, and then we kind of dive down to efficiency and valuation. It does check off a lot of the boxes. Revenue's been growing at just under 12%. We got gross profit expanding to 14.7% CAGR, and margins have gone up by 11.6 percentage points over the last 9 years or so. EBITDA has gone up 18%. EBITDA margins have increased by 14%. Net income has also increased to 26%, and operating cash flows have gone up almost 18%, with free cash flows growing at 19%, and margins also expanding for every single category. So it does have a lot of checks over here, as you can see that the status is pretty good for a lot of these metrics. The only thing that's kind of like analyzed in this example is stock-based comp. It's up 17% on a compounded basis, and a percentage of operating cash flows, it's 9%, and free cash flows, it's almost 14%. So a pretty substantial number there. And earnings per share are also up 25% on a compounded basis. That's phenomenal, from $1.36 to over $10.55. And of course, the shares outstanding are modestly higher, up 39 basis points. Now, balance sheet is not the best. I mean, they do have very strong current quick ratio. Debt to free cash flow is a little bit over 4. We like for this number to be under 3. Net debt over EBITDA is 1.4, so again, under 2. The company does have more debt than cash on the balance sheet, over $11 billion worth of debt, but cash has also been growing at a faster rate compared to the debt levels, but still lower than the amount of debt that they have on the balance sheet at $7.3 billion. Current assets are more than current liabilities, and total assets also do exceed total liabilities, and goodwill as a percentage of total assets is actually at 48% right now, which obviously is going to be analyzed because that is pretty substantial. It needs to be under 10% as well, right? So that is something to keep in mind, because we don't want companies to account for massive amounts of goodwill on their balance sheet, because goodwill and intangibles, I just want to double check here very quickly. So we're going to go over to Seeking Alpha. We're going to go over to NXPI. And then on the balance sheet section, we're going to quickly take a look at goodwill. So let's just come down. So there we go. Goodwill is going to be 9943 as of the last report, 9937. So we're going to plug that number in, plus intangibles, right? So there's going to be some intangibles, other intangibles right over here. So when you combine those two numbers, we're looking at almost $11 billion of goodwill and intangibles, which again, it makes up a little bit over 48% of the total assets of $23 billion. So again, we want the number of goodwill as a percent of total assets to be lower for any company that we're analyzing. Now, in terms of the valuation, we are trading at somewhat reasonable multiples here. Price to earnings at 17 times. So the earnings yield is almost 6%, with a price to sales of 3.5, price to free cash flow 18, free cash flow yield of 5.5%, price to operating cash flow 12, and price to cash at 12.2, and enterprise value to EBITDA of 10.8. So these numbers are actually quite reasonable, I would say, for NXPI. And if you take a look at these metrics, right, so employees and revenue per employee and net income per employee, very, very important metrics that we look at in terms of efficiency. Take a look at this. In 2013, they were making about $190,000 per employee. That number has jumped to more than $380,000. So they have more than doubled in the last sort of few years, as they have, of course, increased that productivity. And net income per employee has also gone up almost 500%. So they have become more efficient, and that's also represented in the margins as margins have gone up. A return on assets, equity, and capital, all three multiples and metrics have also grown now in the double digits for the company as well. And if you take a look at the forecast, it is expected to grow at a CAGR of 10%. So, I mean, one could argue 10% CAGR and price to earnings at 17 times is a little bit on the higher end, and revenue is expected to grow at almost 8%. But I would also argue the margins are expected to, once again, expand for the business in this particular industry as they have been in the past. So as a result, we're going to plug in, a little bit of a higher multiple than 13, 14, but obviously lower than 17, kind of pricing in for maybe a little bit of that multiple compression. So if we come over to our discounted earnings multiple model, we're going to plug in a net income of $2.8 billion, growth rate of 10%. This is exactly what the analysts are expecting. I'm going to go with about 16 times earnings multiple, 10% discount rate because the company does pay out a dividend of about 2%. So if you come over to the analysis here, you'll notice the dividend yield is 2.25%. So we can go with a 10% discount rate, 10% margin of safety, and about 0.39% share dilution. That's exactly what the company has done in the past. And we arrive at an intrinsic value of $154 per share. Right now, it's trading at about $180 with a future price target of $277 per share for the company. Now, accounting for the discounted cash flow model. So if you're going to come back, free cash flows sitting at 2617. So we're going to plug that number in over here, 2617. We're going to make sure that it's at NXPI. And then we're going to forecast the growth. So in other words, if you come over here, free cash flows have grown by 19% in the last 9 years, right? So that's going to be this number over here. Scroll down. If the margins do expand, we're looking for at least an 18% expansion in free cash flow. So if we go with somewhat reasonable estimates of 16% growth, 10% discount rate, and then 3% terminal, 10% margin of safety, and about 0.5% share dilution, based on a discounted cash flow model, NXPI, one could argue, is indeed undervalued. Even if you go with, let's say, 14% growth, $206 is the intrinsic value based on a 10% discount rate and a 14% growth rate for the free cash flows for NXPI over the next 5 years after accounting for a 3% terminal growth. Even if you bring it down to 2%, and if he reduces this number to, let's say, 13%, now we are kind of in line with the intrinsic value and the market price. So these are the assumptions that need to play out in order for NXPI to be at its intrinsic value and justify its intrinsic value based on today. So that's 13% growth for free cash flows, 2% terminal growth, 10% margin of safety, and about 0.5% share dilution based on the 2023 free cash flows of $2.6 billion. And that's when it would be trading at its intrinsic value. So based on the two models, I would have to defer a little bit more towards the discounted cash flow, but the discounted earnings multiple model is also really important. So I would somewhere put down the range between 155 to as much as 175. So that $20 range is really where I would be looking for NXPI. And the good thing is that it was trading, as low as 139, 140 back in October of last year. Since then, it obviously rallied 70%. And right now, it's still up over 35% at the moment. So that right there would be a very important support. This is the monthly chart that we are looking at. So very, very important support here for NXPI. And this right here is the lower high. A few concerns. Balance sheet obviously is a bit of a concern because the company does have more debt than cash on the balance sheet. So that's really what we have for analysis. And also the goodwill, right? The goodwill and intangibles do make up majority of the assets here, over 48% of the overall assets. So balance sheet does have a lot of analyze tabs, right? So those are things to look into. And stock-based compensation as a percentage of operating cash flow and free cash flow is also a little bit higher. But other than that, I think the valuation is quite reasonable. Not a lot of share dilution, good revenue and earnings expansion and growth, and margins also growing. And it's also operating in an industry that is expected to grow in the future, given how there's going to be a lot of implementation of semiconductors and chips and these types of designers are going to definitely benefit, in my opinion, with the growing demand of chips and semiconductors. So this is really where we are with the technicals. A little bit of that lower high support level is going to stay put at 144. Again, the lower the better, right? We want the companies to be undervalued, not really be at intrinsic value. So support level is going to stay put at 145. And based on the two different models, I would put down the intrinsic value somewhere between 155 and 175 for me personally on an XPI Semiconductor. So I hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. Don't forget, we do have our Patreon. Again, link's gonna be in the description and in the comments below. You can access all the 40 plus private members only videos. I posted a trade idea today for all the members, and of course access our Excel spreadsheets and our Discord channels, over 20 private channels also available with the link down below. As always, happy investing, and I will see you all in the next video. Take care.